All right, so let's stay with big technology. Obviously, the NVIDIA Intel news, a big deal for both chip makers, for the companies that use these chips, and, oh, by the way, for investors in Intel, at least today. Elsewhere in technology, though, Meta, the parent company of Facebook, currently in day 2 of its Meta Connect event. Last night, Mark Zuckerberg unveiling their new Meta Ray-Ban smart glasses. During his keynote speech, you can see that Meta shares are up slightly, about 1.5% with the market today. They have been on a tear this year of more than 30%. Joining us now to talk about it, Clockwise Capital Management CIO James Cakmak, his firm's ETF underweight both Meta and NVIDIA. James, good to have you on the program. What's the issue with Meta?
No, there's absolutely no issue with Meta. We think it's attractively valued at about 27 times earnings or so. But at the same time, you have a growth curve that's growing nicely on the top line, but likely to be growing slightly slower on the bottom line on the years out. So, we still like it. We own the name. We think it should be in almost all portfolios that are growth oriented. But it's really a question of opportunity cost. Can we get higher returns over shorter time frames elsewhere?
Got it. Yeah, and we're looking at these glasses that, and I don't know, 10 plus years ago we had Google Glass. I, by the way, made some ad-lib joke about killing a squirrel, riding my bike drunk, and John Oliver picked up on it and kind of offended me because he said I couldn't ad-lib it, but I did. Anyway, are these going to drive any sales at all, James, or is this Google Glasses too?
No, I mean, I think the Ray-Bans have been selling pretty well. I think that there's a lot of opportunity there, but most importantly, a lot of optionality as we look down the road. The glasses were, I think, more of a Hail Mary attempt and really too early in the technology cycle to release those. But now, I think Meta's onto something here and a lot of optionality, like I said. But the bigger point about Meta and why we like it in the portfolio is, we think ad tech, broadly speaking, is one of the few opportunities in the market where you're actually starting to see revenue synergies from their AI-based investments, whereas most of the rest of the market is more cost-saving side. We saw that last quarter with Meta, and we think that the opportunities for that are increasing by the day.
Yeah, and I don't know how it all works, but I'm assuming they must collect some data from this. Again, I'm guessing. I don't want anyone to hold me to this. But if tech firms can figure out what you're looking at, not just what you're looking, they obviously know what you're scrolling through on your phone, the websites you're going to, but if they actually know what you're staring at and can use that data, I'm not saying I like it, but it's going to provide a lot of ad money, I got to imagine. I stared at the Lay's potato chips for 30 seconds, longingly.
Yeah, absolutely. I think the sky's the limit on that front. Obviously, they have to balance out the privacy concerns and considerations along with that. But I just keep coming back to one thing, optionality. And really, when we're investing within technology, what we're trying to lean into, you mentioned kind of we're underweight NVIDIA and Meta. That's true. But really, what we're trying to balance out is overweighting the companies with the most optionality to them. These are grind higher stories. They should be in the portfolio, but convexity matters. And in a volatile market like this, you have to be able to maximize returns over shorter periods because, you could have one-year price targets achieved in a matter of a week. And it's just the times that we live in. So
what is undervalued then, James? Like what would be something that is not everybody's not already been buying?
Yeah, we talked about this last time. I keep coming back to Bitcoin. I think Bitcoin specifically, continues to be the most underappreciated asset in the market and likely to be the best performing asset class in 2025 and thereafter. Two is, I don't think all semis are created equally. We're underweight NVIDIA, but we're dramatically overweight companies like Micron. Do you think of higher convexity, higher return potential there as the multiple expands? And you don't have the China risk that you do with NVIDIA. There's smaller cap companies that we like that have, from an economic standpoint, the opportunities like Upstart, KKR. So there's pockets of opportunities everywhere. I don't think you have to ride the whole big tech wave exclusively to participate and do it in a much more diversified way.